What's up, guys? Hove here, and today I'm going to do a follow-up on the Bitcoin video that I did the other day. You guys absolutely crushed it with all the likes and retweets. I really do appreciate the support, so I wanted to make this video worth it for you guys. And in the video, I'm going to go over the resistance that I talked about, introduce a count that I haven't seen floating around, and go over some algo stuff and maybe some time stuff if this doesn't go too long and get boring. So with that said, let's jump in. Last time I left off on this video, we had this big red box of resistance. I went over all the pulls that we did. We had one here, here, here. I just have this one on there right now, but we have this big box of resistance that we're sitting in right now. I think this is probably the worst time to be a buyer if you're a trader, because we're sitting in this resistance. To really say that we're in a bull market, we're going to need to get through it, retest the lows, and then we can claim to be in a bull market. But what I'm going to do in this is give you the best case for why we're not in a bull market yet, and just show you that there still is that possible new low there. If you're an investor, you can buy here, buy and hold, but it's still pretty much the wrong spot. You should have been laddering into positions through this wave, which is what I did. I laddered into Ethereum, and I think my last fill was right around $85. But that's an investment for me. That is not a trade. When it comes to my trading capital, I have an allotment for investments, which is the majority of it. I have an allotment for swing trades, and I have an allotment for day trading. And I don't think that you should use 100% of your capital on any trade. It's possibly the worst thing you can do, but it's really up to you. That's just how I do it. Now, I guess that's pretty much it. Let's jump right into it. And the reason why I chose this fib pull is because in the last video I said, well, oftentimes we don't know which swing high and swing low that the algos are working with. So one way to figure that out is I pulled those three that I showed you, and then I just looked at the fib levels for reaction. And you can see this one, the first reaction is almost to the tick of the 236. We get, what is this? 1, 2, 3, 4, 5, 6 reactions at the 236, maybe 7. And then we finally get through and pump through on that dilly. And that's great. I mean, this shows a lot of participation on this algo pull. We didn't get any here besides it acted as support. But then the next reaction is at our 50. We got, what is this? 1, 2, 3, 4, 5, and now we're working on the 6th touch of this 50 to where we might break through and get up to this level, or we could turn over here. But this is the algo that I think has the most participation. It doesn't mean it's the right one, but it's the one that I'm following closely to see the reaction. Now, with that said, it can turn around at any moment now. We're seeing a decrease in volume. We're super overbought here. So reason you don't want to be a buyer in this case. And worst case scenario, it gets up here in 5 waves, breaks through, and then you catch a retrace, because this would all just be the one. Breaks through and you catch a retrace pretty much at the level that we're at. It could be lower, it could be higher, but that is what you want to look for. Now, let's jump over to that new count that I was talking about. this is the count that I'm proposing, and I've put it alongside the fractal from 2014. Now, I know people say, oh, different years, different corrections, yada, 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 but I just want to do it to show you the similarities of where we're at in the market. Now, you can see in this count, the reason why I changed this, let me go back to this one, I believe. A lot of people have this triangle, and because of this wick on Bitfinex, it's not the best. It comes way up here, and that definitely breaks the rules of a triangle. It goes well beyond the C. So I wanted to look at it again, and then I put this fractal up there, and I wanted to see how it matched up with this. And if you look, it's almost identical to how we've been going through this bear market. You see we get these wicks down for our W. It almost comes straight up for our X, and it comes down for an A, retraces for this B, comes down as a C for our Y, which does get us a new low on all the exchanges. So that still fits. Then we get this A, B, C. Now this X is a lot more impulsive and strong than this year's X. I think that we get this strong A, we get a B, and then we get a ending diag for the C that becomes truncated. Now, I don't like truncations, but again, I'm just introducing another count that can kind of give us an idea of where we are in the market. From there, you see we get this clear 1 down, 2 up, and then we have this flat action here, which is almost similar, almost identical to this. It's very flat throughout here, and then we finally get a sell-off. Now, this was a lot more vicious than this move right here. It almost looks to me that the 2014's bear market was more bullish than the one we've been in, because we get truncations on a C and then a stronger rip on the A. And then from here, this is where we're at. You can see we get this move down for our A, and then it comes up, retraces, and we get the B. Pretty much identical to where we are now. Now, this can be counted multiple ways. It can be a WXY, it can be an A triangle B, and now we're working on that C. Just like this can give us multiple counts, this can do the same. But from there, right now we're hovering right here, and I did the fib pull on this. It got to the 50, pretty much where we are now. It's just a little bit higher this year, but this has taken almost twice as long as this. So for that, I want to take a look at the algos, because we know that the algo has been on the money this whole time. So I wanted to show you just how the algos have been working throughout 2014's bear market and this year's bear market. So this is 2014. I'll try to make this a little bit easier to see. Might be hard, but these are all the algo strikes, and I mean, there are countless, and not a single one has failed. If you look, we just do swing high to swing low, algo reaction. Swing high, swing low, algo reaction. Swing high, swing low, algo reaction over here. It took a long time. Swing high, swing low, algo reaction. Swing high, swing low. And you can do this throughout this whole thing without an algo failing. Nothing misses throughout this whole thing. These are all the targets that we see. Also, we'll pull from this major one through our first leg. This is the algo that has been running this whole thing. And if you look, you take this all the way over and it hits. all the way over here. It did not miss. We can do the same thing with all of these. Swing high, swing low. This is the only one that doesn't get it. But if we're pulling from this, we would pull from the X through our Y, and you can see right there, gets it perfectly. We'll do the same thing with this one. Swing high through swing low. Boom. Perfect reaction. Now let's take a look at this year's. Jump over to this one. This is this year's. I did pretty much the same thing. Swing high, swing low, algo reaction. Swing high, swing low, algo reaction. Swing high, swing low, algo reaction. Throughout this whole thing, these are all the algos that have participating. So, one thing that we're left wondering is if nothing missed on the last bear market, why would you miss on this one? And if I pull from our swing high through our swing low, we still have this algo sitting here waiting to take profit. Look, doesn't get it, not even close to it. So what makes this year's differently, especially when we've seen that it's been less bullish on these retraces, and the retraces have been taking longer than 2014's. So next thing I want to look at is the time. Now, this is 2014's and this year's. So I've done the time of each leg, and it roughly comes out to being 1.5 times as long here. But if I do just a pull from here to where I think our bottom is, which is here, then that comes out to be 1.17. And if you look at 2014's market, that was 410 days for the bear market to bottom. And if we multiply that by 1.17, that puts us at 480 days basically. Now let's pull this over to here from the start to where 480 is. That's right here. So why, if this whole thing has been taking on average, we'll say 1.17% longer than 2014's market, why would we end the correction earlier? That is the question. So we have a lot of arguments here. We have all the resistance that we still need to get to. We have this count where we're sitting in this B still. We have all the algo participation, and according to the numbers, we still have more time to deal. If we go by the average, which I calculated out at 1.5, that puts us roughly at 500 days. There's still a while to go in the bear market. Now, I'm not saying that's a for sure thing. It can be. It might not be. But this is my argument to why you shouldn't be a buyer right now. If we get through in 5 waves and we retest those lows, I'm all there with you. But right now, I just want you guys to be safe and not become panic sellers when this turns around because the algos decide to take action. All right. Yeah, that's pretty much it, guys. I hope this helps. I hope it wasn't too long. I tried to keep it short, but with a lot of information. I didn't want this to drag on forever. Yeah. If you guys have any questions, you can always shoot me a DM and we can go over a few things. Or if you see this correction differently and maybe you're on the bull side, show me your case. I'm more than willing to check it out. But again, I appreciate all the likes and retweets. If you're watching this on YouTube, go ahead and give me a follow on Twitter. I typically post most of my videos on Twitter. The longer ones go on YouTube, but it's not too often that I do that. I'll put the link below for my Twitter, and if you like this, and subscribe to the YouTube channel. All right, guys, I hope that helps.